For more than a decade, Australians have heard a version of the same promise. House prices may pause. They may flatten. They may even dip for a few months. But because Australia does not build enough homes, because the population keeps growing, and because everybody wants to live near the same major cities, property prices can never really fall. That belief is now being tested. Australia's national home values fell in June, completing a negative quarter. Sydney and Melbourne are leading the decline. Sales volumes have weakened, advertised stock has risen, and capital city auction clearance rates have slipped below 50%. But Australia is not the only housing-obsessed country where the market has started to turn. Canada spent years telling itself a remarkably similar story. Rapid population growth, chronic shortages, global cities, and property so culturally important that a major correction seemed almost impossible. Today, Canada's national benchmark price is lower than it was a year ago. Ontario apartment values are down 8%. Home sales in Ontario and Vancouver remain below their 10-year seasonal averages, while the number of homes listed for sale sits far above normal. So, is Canada showing Australia what happens next? Or is Australia's housing shortage still powerful enough to stop a genuine crash? Before we go any further, there is one important correction. Canadian house prices are not nationally at a 10-year low. That claim is too broad. What is true is that activity in some of Canada's largest and most expensive markets is operating well below 10-year norms. Prices are falling in important regions, listings are elevated, and the market is much weaker than the national average sale price can make it appear. The same discipline is needed when discussing Australia. Australia is not yet experiencing a nationwide crash. It is experiencing an early and uneven correction. Some cities are falling quickly, while others are still rising. That distinction matters because the real question is not whether one monthly index printed a negative number. It is whether the forces underneath the market are beginning to change. And in Australia, several of them are. According to Cotality, Australia's National Home Value Index fell 0.4% in June 2026, the largest monthly decline since December 2022. National values peaked around March and fell 0.7% over the June quarter. But the national number hides a huge divide. Sydney values fell 3.2% over the quarter. Melbourne fell 2.6%. The Australian Capital Territory fell 1.3%. At the same time, Brisbane still rose 0.3%, Perth rose 0.7%, and regional Australia rose 1.1%. In other words, there is no single Australian housing market. The correction is currently concentrated in the cities where housing costs are highest, household budgets are stretched furthest, and buyers are most sensitive to borrowing capacity. More importantly, the weakness is visible beyond prices. Capital city home sales over the 3 months to June were estimated to be 16.2% lower than a year earlier and 14.5% below the 5-year seasonal average. Advertised stock was almost 11% higher than a year earlier. When sales fall while available stock rises, sellers face more competition and buyers gain more choice. That does not guarantee a crash. But it is the opposite of the conditions that drove the pandemic-era boom. The market is not simply getting slightly cheaper. It is becoming less liquid. The most obvious pressure is interest rates. The Reserve Bank's cash rate is 4.35%. Higher rates reduce the amount a household can borrow, increase repayments for variable-rate borrowers, and force buyers to compete with smaller budgets. But the deeper issue is that Australia entered this period with extreme affordability pressure already built in. The National Housing Supply and Affordability Council estimates that a new mortgage required 45.9% of median household income in 2025. A median income household needed around 11.2 years to save a 20% deposit. A newly leased rental consumed about 1/3 of median household income. This means the market can weaken without becoming remotely affordable. Imagine a home that rose from $800,000 to $1 million during the boom. A 10% fall takes it to $900,000. That is a serious loss for somebody who bought at the peak, but the home is still $100,000 more expensive than it was before the final surge. That is why falling prices and affordable housing are not the same thing. Australia's problem is not merely that prices went up last year. It is that prices have been separating from incomes for decades. Eventually, however, even a severe shortage can collide with a hard financial ceiling. Buyers may still want the home. They may still need the home. But if the bank will not lend enough and the repayment cannot fit inside the household budget, demand disappears at the price the seller expects. That is the pressure now appearing most clearly in Sydney and Melbourne. If the market is this unaffordable, why has it not fallen much further? The first reason is population growth. Australia's population increased by about 412,500 people during 2025, or 1.5%. Net overseas migration contributed roughly 301,000 people. That growth creates real demand for rentals and homes, especially when new construction is already constrained. The second reason is supply. Australian dwelling commencements fell 11.2% in the March 2026 quarter. Starts for apartments and other higher density homes fell more than 20%. So, at the same time that affordability is weakening demand, the future supply response is moving in the wrong direction. The third reason is that Australia does not yet have widespread forced selling. The Reserve Bank says housing loan arrears remain low, most mortgaged households have remained resilient, and less than 1% of borrowers are estimated to be in negative equity. That matters because true housing crashes are rarely caused by buyers simply deciding prices feel too high. They are usually accelerated by owners who must sell because of unemployment, unaffordable repayments, divorce, business failure, or expiring credit. Australia has weakening demand. It does not yet have forced selling on a national scale. This is where Canada becomes useful. Canada is not a perfect model for Australia, but the similarities are difficult to ignore. Both countries concentrated population growth in a small number of expensive cities. Both treated property as a primary path to household wealth. Both struggled to build enough housing in the places where people wanted to live. And both developed a powerful belief that immigration and shortages placed a permanent floor under prices. Canada's latest national data is not a complete collapse, but it is clearly weak. In May 2026, national home sales jumped from the previous month, yet remained 5.1% lower than a year earlier. The National Home Price Index was down 4.1% year-on-year. At the same time, Canada's average sale price was actually 1.5% higher than a year earlier. That sounds contradictory, but it reveals an important lesson about housing statistics. An average price changes depending on which homes happen to sell. If a larger share of transactions occurs in expensive cities or among detached houses, the average can rise even while the price of a typical comparable home is falling. The benchmark index is designed to track the underlying market more accurately. So when somebody claims the Canadian market is fine because the average price increased, they may be looking at the wrong measure. The clearest weakness is in Ontario and Greater Vancouver. Ontario recorded 18,051 home sales in June. That was higher than a year earlier, but still 12.3% below the 10-year average for the month. Meanwhile, active listings were 41.6% above the 10-year average. That combination is crucial. The market is completing fewer sales than normal while buyers have far more homes to choose from than normal. Ontario's composite benchmark price was down 4.6% from a year earlier. Apartments were down 8%. Townhouses were down 6.6%. Single-family homes were down 4.2%. Greater Vancouver tells a similar story. June sales were 12.4% below the 10-year seasonal average. Active listings were 30.2% above it. The composite benchmark price was down 6% year-on-year, while detached homes and apartments were both down about 7.1%. This is the accurate version of the headline. Canadian home prices are not nationally back at 2016 levels. But parts of the market are operating far below their normal sales activity, with unusually high inventory and meaningful price declines. The 10-year story is mainly about activity and liquidity. And liquidity often turns before the most dramatic price movement appears. Here is the part that should make Australian viewers pay attention. Canada's central bank policy rate is 2.25%, almost half Australia's cash rate. And yet Canada's major housing markets remain weak. That shows why interest rates alone cannot explain a housing market. One of the biggest Canadian changes is population growth. Canada's population fell by about 55,000 people in the first quarter of 2026. It was the country's second consecutive quarterly population decline, driven by a large reduction in the number of non-permanent residents. The federal government has deliberately reduced temporary resident arrivals and is targeting 385,000 new temporary residents in 2026, while aiming to reduce the temporary resident population to below 5% of the country by the end of 2027. For years, rapid population growth helped absorb new apartments, support rents, and create confidence that almost any housing supply would eventually find a tenant or buyer. When that growth slows suddenly, the equation changes. Investors face softer rents and higher vacancies. Developers struggle to pre-sell enough apartments to finance construction. Existing owners compete with more listings. Buyers realize they can wait. Canada's housing agency expects construction and home sales in Ontario and British Columbia to remain weaker than their 10-year averages. Ontario is also the only Canadian region it expects to record another annual price decline in 2026. Canada demonstrates that a housing shortage does not make prices invincible when demand, population growth, credit and confidence all turn together. Australia already has some of the ingredients. Prices are falling nationally. Sydney and Melbourne are leading. Sales are weak. Listings are rising. Borrowing costs are high. New construction is slowing. But Australia is still missing several conditions that made Canada's correction more severe. Australia's population is still growing, not shrinking. Rental demand remains strong. Mortgage arrears remain low. Most borrowers still have equity. And while advertised stock has risen, the country remains structurally short of homes. So the most likely near-term outcome is not one neat national crash. It is a divided correction. Sydney and Melbourne can fall while Perth or Brisbane holds up. Expensive apartments can behave differently from scarce family homes. Investor-heavy suburbs can weaken faster than areas dominated by long-term owner-occupiers. The danger is assuming that undersupply protects every property at every price. It does not. A shortage can support the long-term value of housing while buyers still refuse, or become unable, to pay yesterday's price today. Canada is not proof that Australia must fall by the same amount. It is proof that the phrase, "we do not build enough homes," is not a complete market analysis. Over the next year, 6 indicators will decide whether this remains a modest correction or becomes something more serious. First, unemployment. Job losses convert stretched borrowers into forced sellers. Second, migration. A sharp reduction in net overseas migration would weaken both rental and purchase demand. Third, active listings. Rising stock matters most when it remains elevated for months rather than weeks. Fourth, mortgage arrears and negative equity. These reveal whether price falls are becoming a financial stability problem. Fifth, Apartment construction and pre-sales. Weak development today can deepen shortages later, but failed projects can also expose investors and lenders now. And sixth, the gap between asking prices and completed sales. Sellers can resist lower prices for a while by simply refusing to sell. A real repricing occurs when enough of them accept the new market. Watch those indicators, not just one national median. Australia's housing market has turned, but it has not collapsed. Canada's experience shows that even a country with major housing shortages, expensive global cities and years of rapid immigration can suffer a sustained correction when population growth slows, inventory rises, credit tightens and confidence breaks. Australia currently has weaker sales, higher listings, high interest rates and falling prices in its two largest cities. But it still has strong population growth, chronic undersupply and relatively resilient borrowers. That leaves Australia in an uncomfortable middle ground. Prices can fall enough to hurt recent buyers without falling enough to help first home buyers. Construction can slow because the market is weak, making the long-term shortage worse. And a correction that appears healthy can become dangerous if unemployment or forced selling begins to rise. So Canada is not a prediction. It is a warning. Housing shortages can delay a downturn. They can soften it. They can even create the conditions for the next boom. But they cannot make a market permanently immune to gravity.